Hi, everybody, and let me just adjust the lights here. I forget this. I don't want that so bright. The lights are way too bright, so okay, that much better. Hi, everybody, and welcome to part 2 of chapter 3, which is financial statements and financial ratio analysis. We left off on debt ratios. So I covered some of this last class because it overlapped by a little bit here. But basically, the debt ratios, we want to have a good understanding of how much debt a company is being involved with, because debt is critical, or one of the key inputs to a company becoming financially insolvent. So companies with no debt, it becomes very difficult to become financially insolvent if you don't have any debt. Specifically, if you're making profits, even harder. Some companies can make a tremendous amount of profits, but if they have more interest expense than profits, then they're fiscally bankrupt. So keeping an eye on debt ratios is a key consideration for financial analysts, banks, creditors, stockholders, because you don't want companies to take on too much debt that could lead to severe problems in the future. I remember before Boston Market was Boston Market, it was called Boston Chicken. And Boston Chicken was a fast-growing, hot fast food restaurant that had very bright prospects. It took on way too much debt too quickly, and eventually the company had to go into a form of insolvency and later purchased by McDonald's and rescued. But the company had just gotten too far ahead of itself, trying to open up, borrowing too much money too quickly to open up too many locations. So it could be, in some cases, you have a restaurant that's working, but that taking on too much debt too quickly can make it much more difficult to sustain or maintain your financial solvency. So that's why when we look at something like the debt ratio, looking at the total liabilities to the total assets, we want to know what, it basically tells us what percentage of the assets are financed with debt. So the lower this percentage, the better, as far as having what we call a strong balance sheet. So a strong balance sheet would be a company that has very little debt. Now, the debt-to-equity ratio is looking at the comparison of liabilities to equity. So this is basically what percentage of the company what percentage of the total assets are financed by liabilities in relationship to the common equity. So, for example, if you owned say you bought a car, the car is worth $20,000, and you put in $15,000 into the car. So your equity would be 75%. Your debt would be 25%. So if the car is $20,000 and you had to borrow $5,000 to acquire the car, 25% of that car is represented by debt. 75% is represented by the debt to equity. So this debt to equity is looking at this ratio between equity and debt, or total liabilities, which is important, again, to see. And again, this ratio is going to tell us how financially stable the company is. So we want companies to be more funded by equity and less funded by debt. Shows they're fiscally stronger because they're not going to be tied to having to pay a tremendous amount of interest on, which is what debt requires. So one way of measuring the ability to pay the interest in one number would be times interest earned. So for example, if you had a credit card over here, right? So you had a credit card and you owed $5,000 on your credit card, and your interest on that card was $500. We'd want to know, is that a problem for you? If you make no money, a $500 interest payment a year on your credit card, that's not good then. So if we had a multiple, which would be, think of earnings before interest and tax as your monthly pay, right? That's your monthly pay. So if you had a monthly pay of $5,000 and an interest of $500 a month, divide 5,000 to 500, you get 10. So you have, so this multiple, would that be 10? 5,000 by 500, right? So you get 10. So your multiple here would be saying that you could pay your interest, you have 10 times the ability to pay the interest on your credit card debt. So it's really not a problem. So if you look at a company and you look at their earnings before tax divided by their interest, you get a multiple of how many times their earnings is of their total interest. And if it's less than 1, you've got a problem. So the higher this number, the better. The more income you have to finance and service your debt. Just like the United States has a huge amount of budget deficit and total national debt. So we're talking about $20 trillion of national debt. You're like, that's an astonishing number. But since the revenues, or the ability to enhance the revenues of the government and the earning power of the citizens of the country are far greater, it doesn't seem like that big of a concern right now because the company can manage to finance that and pay the interest out of the taxes they collect. Some countries like Greece didn't have that same equation. They did not raise enough money to be able to finance their debt as a nation, and that led to a lot of disruption, a lot of reformation or reconfiguration of the government. Okay, so now here's a hard one. Fixed payment cover ratio. So here's the fixed payment cover ratio. So this is a little bit more complex of a formula if you look at this, right? We have earnings before interest and taxes plus lease payments. And we want to divide this by interest plus lease payments plus principal plus deferred stock dividends times 1 divided by 1 minus the tax rate. So this is going to really, this is sort of a little bit more fine-tuned of a ratio to measure the company's ability to meet all their fixed payment obligations. So for example, in your case, you might want to look at what is your monthly income versus your rent, your cell phone bill, your subscription accounts. Things are fixed costs that are fixed payments you have to make every month. What's that relationship to your actual income? So you don't want to rent a $3,000 apartment when you make $2,000 a month. So looking at this ratio will quickly tell us what is the company's coverage ratio compared to their money coming in relationship to what the money going out, your fixed obligations. So we're not talking variable obligations like wages or things that might be tied to these variables, but we're talking about those fixed, we know we have to pay every month payments. The formula is a little bit bigger than most of the formulas in the ratio area, just because it's pulling in more pieces of information. All right. Now, if you remember back to the spreadsheet we talked about, common size income statements, this is where we looked at the income statement year over year with a percentage to see what we're trying to see. Remember this now, worse, better. We kind of went over this in class. So what we're doing is we're converting the 2015 and 2016 income statement into percentiles based on sales revenue. So sort of sales revenue divided by sales revenue is 100%. Cost of goods sold divided by sales revenue is 65%. So we're putting everything in a percentile basis. So we can more easily tell if things have increased or decreased, like profit margins, cost of goods sold, EBITDA, income, net profits, taxes, and of course, this better or worse is the evaluation. If cost of goods sold goes up, the percentage of cost of goods sold goes up, that's worse. But if you have more sales, your cost of goods sold number will be higher, but you don't know if it's better or worse unless you see the percentages of it. So the common size income statement is giving us a more easier way to convert everything into more of a ratio, so the comparable year over year, when the numbers are not going to be identical, the ratios will be comparable, will make things more comparable rather than trying to look at two different years worth of income statements. So as we saw before, it's a simple calculation, but this helps us to quickly analyze whether or not the company is doing better or worse moving from 2015 to 2016. In most cases here, it seems like they're doing worse. So let's get to the most important profitability ratios, the gross, operational, and net profit margin. So first one, the gross profit margin. It could be sales minus cost of goods sold divided by sales, or gross profits divided by sales. Both of them work. Actually, sales minus cost of goods sold is gross profits. That's why both those formulas work. Now, this is extremely important in the simulation because you're starting off at a 40 percentile base on the simulation of gross profit. So whatever you do, it's expected that every year you make that higher. That's what you're being hired to. We're hiring your team to constantly increase the gross profit margins. Two ways to do that: raise prices or lower costs, or both simultaneously. So, but this is going to measure a percentage of which each sales dollar remains as profits, gross profits. After that, we move into operational profit margins. So again, operating profits, sometimes EBIT, divided by sales. And this tells you, by the time you get to you subtract out the operational costs, what's the profit percentage at that point? And it's always lower, because you're taking out wages, SG&A, you're taking out operational costs, you're taking a big operational cost that you have control of in the simulation, the business simulation you're working on, is marketing. If you over-market, you may have, and this is how you could tell if you over-market it, you put double the money in marketing than suggested. So your sales go up a great deal, but now your sales demand is 3,000 cars, you only built 2,000 cars. So you wasted that marketing, because there's 1,000 cars you can't sell because you didn't build them, even though your marketing built up the demand. You spend an extra $10 million to get those extra 1,000 cars, but since you didn't inform the person working on production and the person working on forecast that this was going to happen, the company under-forecasted, underbuilt, and now that marketing was wasted. But what's the result is your operational profit margins go down much faster than before because you're wasting money. So if the activity of the operations are more effective, your inventory, your accounts receivable, all of those operational measures, the more effective they are, the more operational profits you'll retain. So companies are always looking at, how can I make these operational profits higher? Because we have, after raising the price and lowering the cost, of course, that's at the gross profit margin level. At the operating profit margin, I can do things like lay people off. I can cut the marketing budget. There are expenses that I control, cut the office supply budget, move to a cheaper location, and reduce the rent. So there are things that operationally you could do to help lower the cost of the operations, to help increase the operational profit margin. And as we saw in the fast food industry, these companies spend a great deal on marketing, and that's why we see these big falls from 40% gross profit margins to 10% or 15%, because so much money is being spent in the operations of the business. Now, over here, the net profit margin, we're talking about the net profit margin. This is the two things here are going to be taxes and interest. So you can't control the taxes of the simulation because they're fixed. But the interest you can control by reducing the amount of debt you have in the simulation or in the company you're running. So if you reduce the long-term, short-term debt, that's going to reduce the interest, and one of the measures to help increase your net profit margins. But also increasing your gross profit margins trickles down into increasing your net profit margins. So your net profit margins are never going to be larger than your operational or your gross. So if you move your gross from 40 to 55%, that's naturally going to lift up your operational and net profit margins. So in the beginning of most businesses, and of your business you're running, you're going to be borrowing money to finance factories and operational investments. This is going to increase the amount of interest you're paying and is going to dampen your net profit margin. However, as you move forward and your company becomes bigger and more stable, you'll be able to pay back that debt and reduce your interest expense, and that will increase your net profit margins. Increasing your net profit margins increases your earnings per share, increases your total asset turnover, your return on equity, not your total asset turnover, your return on assets. So it has a huge impact on a lot of ratios. So that's why you always want to make sure you're increasing gross, operational, and net profit margins as much as possible. And just like companies are run in the way that very efficient households are run. So if you have a very efficient house manager or someone in control of the budget, they may not have those titles in your household, but this is the person who is making sure that food isn't being thrown out or wasted, making sure that lights aren't being left on and electricity is being wasted, making sure that they get the best deal when they order fuel for oil, or when they negotiate, when they're looking for a bank account, getting the best interest rate, doing everything possible, clipping those coupons, reducing those costs, making those dollars go further in an effort to overall reduce the expenses and spending of the household. So the closer you look at every penny and question everything being spent, the more efficient your budgets and your financial life would be, and the bigger savings you'll have. That's what many individuals skip out on doing this. They don't spend a lot of time looking at the budget, thinking about their money, thinking about how they're going to invest or save, or how they can cut costs, because it's effort and it's work. It's a lot easier just to go out and spend the money, go out and buy dinner rather than make it at home, go out and, buy a bunch of food and then throw it out because it spoils, rather than carefully planning a meal prep to efficiently prep several days worth of meals and efficiently use all the food that you have. It takes effort. So companies that put more effort into doing this, and companies are basically incentivizing their employees to do this, so if you don't do it, you're fired. And they hire the new person to come in to make sure that the company doesn't waste a penny anywhere, because your competitors will use that as an advantage to take you over quickly. So these profit margins are probably the most important ratios of all the ratios to look at, focus on, and improve, or question when they go down. Okay, so this will have a trickle-down effect into earnings per share and return on assets. So the net income, what we're called here in the slide, earnings available for common stockholders, is basically net profit or net income. So this number divided by the outstanding shares gives us the earnings per share. So if I'm a stockholder and I own one share of stock, this is the earnings that the company generated in relationship to that one share of stock. Now, I don't get those earnings unless they're going to meet they have to be paid out as a dividend before I could get those earnings. But the earnings per share is what we want to see increase. So in your business that you're running, the simulation that you're running, I'm just going to call your business for easier sake right now, you want to see those earnings per share go up. When the earnings per share goes up, the stock price goes up. There's a direct correlation between companies come out with higher earnings per share, you're going to bet that their stock price is going up. And if they beat or exceed those earnings per share expectations, stock prices are going up. If they come out and the earnings per share are lower than expected or lower than last year, stock prices are going down. So that's why this is such a critical ratio. And it all happens by increasing those gross profit margins. Operational and net profit margins will increase those earnings per share. Investors look at this and focus on, this is one financial ratio that's focused on a great deal by everybody. Return on assets is also going to be looking at this net profit divided by total assets. So we want to see, what are the profits in relationship to the assets? Are the assets being utilized to generate profits? So if you go ahead and you buy 5 factories you don't need, you're pumping up your assets by $100 million. If your profits don't go up by a similar amount, this ratio is going to go down. So your return on total assets, or ROA, you may see this being decreased in the first couple of rounds that you're playing the simulation as you're bringing in a lot of assets. But those assets will start to generate much more profits and benefits later, second half of round 3, 4, round 4, 5, and 6. You'll see the assets and the return on assets start to increase as you don't need to accumulate as many assets in relationship to where your business is. And then that's what businesses are trying to do. So when businesses first start up, they may acquire a big oven for their pizzas or 7 soft-serve machines for their frozen yogurt, and that's going to make their return on asset look terrible until they get to a business size high enough where the sales have grown bigger than the assets and producing profits that are ever increasing compared to the total assets. So total assets remain the same, but profits keep increasing every year. You're going to see that return on asset percentage increase as well. Now, return on equity is a similar concept where we take those net profits also, as I said here, referred to as earnings available for common stockholders. If you take those earnings divided by the outstanding shares, you get the return on equity. No, actually, that's not right. They're missing, let me just fix this slide. It's not the number of it's the number of outstanding shares. Actually, I think they didn't finish the, it's the number of outstanding shares times, oh, that's just, it's just a picture. I'm just going to write down here. It's the earnings, we're going to say, divided by, and you could say number of outstanding shares times stock price, or total equity as a dollar amount. So you want earnings as a dollar amount divided by total equity as a dollar amount. So what they meant here, I think it's been cut off, it's the number of outstanding shares times the stock price would give you total equity in the company. So earnings divided by total equity gives you the return on equity, or ROE is sometimes known. So let me just improve that slide there. Okay. So this gives you a percentage of earnings compared to total equity. So what could be confusing about this is if a company takes on a lot of debt, their equity would be suddenly smaller in the company in relationship to the, how the assets are funded. So the earnings compared to a company taking on debt, we could see this artificial growth in return on earnings because the equity pool is smaller in relationship to how they leverage the company. So for example, if you had that one store for $1 million and you made $100,000 and you totally own the store, it's your money to buy it, and you invested $100,000 to buy the store, and it makes $10,000, that's going to be a 10% return on equity. Your equity generated a 10% return. But if it was the other case where I said you take that $100,000 and you put $10,000 down on 10 stores and borrow $90,000 on those 10 stores, now you have the earnings are not going to be $10,000, it's going to be $100,000. So the earnings have been increased by the leverage. The equity is still $100,000, but you have 100% now return on equity because you leveraged up. So this return on equity can measure the effectiveness or efficiency of the leveraging. That's why when you look at return on equity, you want to know, you also want to understand how the equity to debt balance has been changing in the company over time. If it's been pretty stable, then you can look at a year-over-year change in return on equity. But if the company suddenly borrowed a bunch of money to double their locations, you're going to see a huge increase on return on equity because they're using debt to expand the business greatly, which is going to generate a lot of profits. But the hindsight of that is it's making the company riskier because they borrowed all this money. So even though return on equity may increase, that's not necessarily saying it's 100% good. Yes, it's good that return on equity increases, but it's not good if it resulted in a much riskier company because they took on all this additional debt. Okay, price to earnings ratio. So here again, first, okay, so price means stock price. Whenever you see price, the price you're talking about is the stock price divided by the earnings ratio. So that gives us the market price per share of common stock divided by the earnings per share. So sometimes referred to as a PE ratio, price to earnings ratio. So what we're looking at is if the stock price is $25, the earnings per share is $5, the PE is 5. If the stock price goes up to 100, but the earnings per share is still 5, now the PE is not 5, it's 20, because it's the stock price divided by the earnings per share. This is a measure of how well liked the company is. So the higher the PE multiple, the more enthusiastic investors are at buying the stock, the higher the stock price is going up in relationship to the earnings per share. So when you get a high PE multiple, it's like having a lot of likes on your Instagram photo. So you have an Instagram picture and you usually get 2 or 3 likes, and then you put your dog on your Instagram picture and you finally get 100 likes. That tells you that that picture is much more liked than the other pictures you take of the food you eat during the week. So that kind of says, okay, this is the winning picture, the picture most people like. High PE, the higher the PE multiple is, the more people like the company. And that's why you see some companies with very high PE multiples, because a lot of the investors really like the company and putting money into the stock. Market to book ratio is, market means the total market capitalization divided by the book value. So book value, how do you calculate book value? First you need to know how to calculate book value per share. So book value per share is going to be the total common stock equity divided by the number of outstanding shares. So if you had a company that had $1 million worth of equity and had 1 million shares outstanding, the book value per share of stock would be $1. $1 million of equity divided by 1 million shares outstanding, book value would be $1. So does this continue? Okay, so it continues. The market to book ratio is going to be the market price per share of common stock. So that's basically the stock price. So market price means basically leaving out stock. It's stock market price per share divided by book value per share. So this gives a relationship. If the book value per share basically says you take all your assets, right? Say you converted all your assets into cash, you pay off all your liabilities, and what's left is your equity. So that equity number we could divide by the outstanding shares to get the book value per share. So book value and equity are the same thing. So the market to book is looking at your stock price versus what we could also kind of call like the liquidation value of the company. So basically, if you had a car, that car before that you put $15,000 in and you borrowed $5,000 for, if you were to liquidate, sell that car, pay back the loan, the equity of that car is $15,000. So that's how you come up with the equity or book value per share dividing by outstanding shares. So this basically tells us if a company has a book value of, say, $1 million and make that per share, it's $100 per share, and the stock price is $1,000 per share, there's a big disconnect between the equity of the company and the actual price to buy the company. So usually we look for, maybe the book value is 2 or 3 times, the stock price is 2 or 3 times the book value. So if the book value is 100, the stock could be anywhere $200, $300, $400 per share. Not so crazy. You could kind of look at it, think about a house. How much would it cost to actually build a house and put it on a piece of land? That's sort of like the book value of the house. It costs $200,000 to physically build the house with labor and materials, and $50,000 for the land. So the house book value is $250,000. But the house sells for $500,000 because that's the market price of that house. The market price is much higher than the actual book value to create the house. So that's profit that's why people are home builders. And they build homes and they build new houses because they know that the book value to build a house is less than the market value to sell it. Once the market value becomes less than the book value to build the house, they stop building houses because it's not profitable anymore. So it's really just looking at the actual tangible value compared to the stock value of a company. And if this gets too out of hand, if the market to book ratio is 20, then it's really outstripped the asset base, the equity base of the company. So that's why we look at it to give a rationalization. Is this company really overvalued or undervalued? So Whole Foods, which this was an analysis that Amazon must have done before they purchased Whole Foods. If you looked at these Whole Foods financial statements that are in the textbook, we see the overall liquidity of the firm increased significantly from 2016. If you look at the activity, it would say that the Whole Foods managed its current assets and to current liabilities reasonably well, judging by the current ratio and the quick ratio. And total asset turnover slowed significantly in 2016, meaning that their assets didn't generate more sales than the previous year. So the debt, we'd see that the debt increased sharply in 2016, but it used less debt on average than the industry. So in 2016, Whole Foods expanded their locations, took on some more debt, but not the same level of industry peers. One advantage you'll see is that Whole Foods has typically higher margins on their business than typical supermarkets. And the reason for that is, why is Whole Foods bringing in more profits than ShopRite in general? Or Kroger, or one of these other...
Their products?
Nope. Nope. Other supermarkets have products and they have organic. What does Whole Foods do that's different than other supermarkets? What's the nickname for Whole Foods?
Whole paycheck?
Yes. And so what does that mean? Prices are higher. So Whole Foods, known as Whole Paycheck, their prices are higher at Whole Foods. Their margins are higher on their products. So they have higher profit margins. That's why they're a more attractive takeover candidate to Amazon than other food supermarkets. Now the reason, because other supermarkets have similar products to what's sold at Whole Foods, but Whole Foods charges a premium. You could see some of the same yogurt brands, some of the same brands in a discounted supermarket compared to Whole Foods, and you know, if you're a frequent shopper, oh, I can get that for 20 cents less at ShopRite, or I could get that for $1 less. And some things are just kind of comparable, like they have what is, you know, the almond milk comparable. But Whole Foods is able to have a higher profit margin because it has a better image, it usually of being more organics than most supermarkets, more ethically treated meat for sale, you know, however their organization goes. But there's been a significant change since Amazon took over Whole Foods. In order to make them more profitable, they folded in Amazon Prime members into Whole Foods as far as reduced or free delivery charges, discounts on a lot of sales, and also restructured their pricing to lower prices on many commonly purchased items to kind of make the store attractive to a broader group of people to shop at. So here, the profitability here in the next slide says Whole Foods is more profitable than the average grocery store, which we just talked about. As far as the market, both the PE and the market-to-book ratios fell in 2016, suggesting the investors were a little less confident in Whole Foods. So as investors started to cool off on the Whole Foods, their stock price went down, their PE multiple went down, which made it a little bit even more attractive for Amazon to go in and purchase them. And a lot of people were shocked that Amazon bought Whole Foods, but they had a rationale to get into some more tangible retail locations, to install their Amazon lockers, to install maybe a base to return products, you know, to give that a little bit further extension, or even give a little more activity to delivery services. I'm not 100% sure why they bought Whole Foods, but they saw it as the best option in that particular arena. So again, these are just the summary of their financial ratios. So I'm going to skip this. I have a different set of financial ratios we're going to look at in a minute. Now, to have a system to complete the financial ratio analysis, there's a DuPont system that came up with a sort of a more formulaic method to analyze financial ratios, and it's all based on the multiples of the firm's net profits compared to their total asset turnover. So if we were to extrapolate the formula for return on assets, you could break it out to earnings for shareholders divided by sales, multiplied by sales divided by total assets, which could be condensed to earnings divided by assets, or return on assets. But you could break in, as you break down, what they're doing is they're going to break down these financial ratios into, and this maybe, it's not super hard to see, but kind of working backwards. So we're starting at return on equity. So if we look at, so this is the DuPont method. We start with return on equity. If we see that return on equity went down, we want to know why did return on equity go down. So there's it's sort of like two paths. The first path, it could be because the return on assets went down. So if return on assets go down, return on equity goes down. Or it might be the financial leverage multiplier. If the FLM changed, that could be what brought down the return on equity. So it's either return on assets or the amount of debt or leverage they're using. So say it was assets that was the problem. Okay, so we have a problem with assets. Why do we have a low return on assets? Is it that our net profit margins decreased or our total asset turnover decreased? If it's total asset turnover, we could look at sales compared to assets. And if we're looking at our assets, did we increase our current or net fixed assets? So you see how we're working backwards to find where the problem is. If the problem was the net profit margins went down, is it because the sales went down or the earnings went down? If it's the earnings, then we could look into, was it the cost of goods? Was it the operating expenses? Was it the interest expense that increased? Was it some other taxes? So we can basically use the financial ratios starting at return on equity, and we're breaking it down to get to where the problem is. So if return on equity decreases, we could follow the path backwards to see where did the change happen that's responsible for the change in return on equity. And that's the basic DuPont system of analysis. So it's just a system of analysis to kind of pile everything up in return on equity that's going to fall into this financial leverage multiplier. Say it wasn't return on assets, the total asset, return on total assets. It was this FLM, which is basically, if we're looking at total liability and shareholders' equity divided by the common equity. This is how we get that leverage multiplier. Again, it's like I was talking about before, how leveraged is the company? So if the company increases their liabilities, they're going to be more leveraged. So if liabilities have increased, we want to see, is it current or is it long-term debt? So what could possibly have happened is maybe the company reduced their long-term debt, and that affected the total liabilities, which affected their leverage multiplier, which ended up in a lower return on equity. So again, it's just a system to move back and forth between the ratios to figure out where the core change happened that was the significant contributor to the change in return on equity. All right. So applying the DuPont system, it allows firms to break down these ratios. So looking at return on equity, sales, profits, as components of net profit margin, total asset turnover, financial leverage. So you can basically be a little detective or uncover the reasons for lower returns on return on equity. So return on equity is known as the return to owners, because equity is your money that you're put into the company. So owners are really keen on seeing that return on equity increase. And when it doesn't increase, they want to know why. And the DuPont system is this analysis system that will lead us to the reason why it did not increase. Okay, so that's the end of the lecture part. I have a spreadsheet I want to look at. At the end of the class, we will talk about the simulation a little bit. But before we get to that, if we go back to the course and we pull down if we go to documents, in-class spreadsheets, and pull down this fast food ratio, so it's at the bottom of the list. If you can't find it, ask your neighbor, because they probably already did, and you might have been talking with someone next to you or just didn't hear me when I said it, but ask your neighbor, they'll get it for you, so I don't have to repeat it 40 times. So what I did here is I just pulled some data out of the internet. Continuing we did a ratio analysis of the fast food industry from that data was actually 10 years ago. This is data I just pulled up today for 5 fast food companies. So basically what I'm going to do is, this would be the current year for Shake Shack. Now you don't necessarily have to follow along with me as what I'm going to post this once I'm done, so don't feel like you have to match me stroke by stroke. I'm just kind of enhancing this analysis. So what I'm going to do is I'm going to bring in I'm going to copy the latest year of Yum and throw that in here. And call that Yum. Let's see. Okay, just make sure it matches. And then we're going to go to Chipotle Mexican Grill, get their most current information. Throw that in here. And then do the same thing for Wendy's. Remember, don't waste your time following me. I'm going to post this. So this is Chipotle Mexican Grill. And this is...
Do you know off the top of your head where you source this data?
Yes, I'll tell you later. Okay. And then let's get McDonald's. Throw that in there. Okay. Let's kill these two columns. Okay. So basically what I did is create a little industry ratio analysis here. And let me just clean this up a bit. Okay. So now this is, we can do an industry average. And what I could do is find the sum. Looking for the sum key, but it's not here. So I'll just do the sum. And then divide by 5 to get an industry average. Copy that down. Okay. All right. Some of these numbers are really big. I'm just want to make them a little smaller. Reining in some of the. Okay. All right. So this is a quick. Let's resize the columns here. Okay. So a little quick. Now, before we look at this, so what we're going to do is actually, you know what I should do is, we're going to come back to this for a second. If we go over to the McDonald's tab at the bottom, let's make this bigger so you can see. We can look at the difference between 2019 and 2018. So in the ratios, a lot of the key ratios we're talking about here, I want to reformat these for a second. Okay. These are big numbers down here. Okay. So if we're looking at these, this is live data, and I got this from StockRow. So in StockRow, you can go on metrics, an annual, and you can easily download data on the financial ratios. So I went into StockRow and I pulled out this data. So this would actually just be McDonald's. So you could look at this data. What we're doing in the last half of this lecture, we're looking at how companies change from year over year. Okay. So if we see this is the PE ratio, price to earnings ratio, and we see it went from 23 to 25, and we had talked about this earlier, that means the company is liked by two more people clicked on the McDonald's like Instagram account and went from 23 to 25. Or The stock's trading at 25 times earnings now. Last year it was trading at 23 times earnings, which is an indication that investors like what they have done because they're buying it more, they're putting more demand on buying the stock price has gone up. So this would be overall encouraging that investors have more vote of a confidence on McDonald's. The PS is price to sales ratio. So it looks at the stock price per share to the sales per share, and we see that sales per share have increased. So that's a good thing. Some of these ratios we didn't talk about in the chapter, it's not included in the textbook. This site just gives you everything. For example, they have ratios on price to cash flow, price to operating cash flow, price to book. Now, there's 0 here, I'm not sure why. So EV would be called enterprise value. So this looks at, it's another type of financial ratio where you calculate the enterprise value of the company, similar to book value, but not quite the same thing. I'll skip some of those. Here's the enterprise value, actually. So the enterprise value can be related to market cap. So that if we were to put this in dollars to make it a little bit more understand what this number is, since it's so large. Okay, so this is 100, and the market cap is 149 billion. So they're saying McDonald's is worth 149 billion. That's just the stock price times the outstanding share. That's the market capitalization. The enterprise value, the value of the business, is being valued at 196 billion. Enterprise value is sort of out of scope for this class, so don't worry about it. It won't be on, you're not going to have to calculate that. But it's basically another way of calculating how much the company is worth. Okay, so we have our quick and current ratios, and we see that those both went down. So we like the quick and current ratios to go up, so they must have somehow either decreased current assets or increased current liabilities, or a combination of both. So that would be a little bit negative for the company. The debt to assets went from 95 to 99, which says they took on more debt. The debt to equity it's a pretty big number. I'm not going to even try to. It's similar. It's a -2. I'm going to skip that for right now because I'm not 100% sure. A negative debt to equity ratio. The total asset turnover. So it decreased from 0.63 to 0.52. So this could happen in your business too. The total asset turnover can decrease. Does that mean that's bad for McDonald's? Not necessarily. What McDonald's had done between 2018 and 2019 is invest significant amount of money redesigning and refurbishing old McDonald's locations. So they have their assets have grown because they spent a lot of money to tear down old, disgusting McDonald's built in the 60s and 70s to make brand new spanking 2020 McDonald's with kiosks and lights and neon and fiberglass or whatever to make it look new. Double driveways, more efficient kitchens, better layouts for the restaurant, more play areas, however. But those assets haven't fully returned to the business their sales yet. So the asset turnover is a little bit lower, but that's okay because if you know anything about McDonald's business, in the annual report, they would have specified, oh, we spent a lot of money refurbishing our restaurants. Okay. But if you look at the operating cash flow and the income, cash flow is up, which is a good thing. These are all zeros. Okay, so return on equity, I just don't think they're able to calculate. Year 2019 may have not been complete before they were able to calculate return on equity. Return on assets is a little bit lower. Yes, return on assets will be lower if assets grow. So we saw here already that assets have grown. We'd expect the return on assets to be lower. Return on invested capital. This is looking at the money that was invested in the company. What's the return on that? So it's again the net income divided by return on investment capital. And again, it's similar to the assets, so that has gone down. All right. So here they have the accounts receivable turnover has decreased. There's just too many zeros here. I should really switch, delete this, and use 2018 versus 2017. Because I don't think at the time this was put together that their 2019 is completely, all 4 quarters are in there. So actually 2017, 2018 is a little bit more comparable. So if we go back down to, okay, total asset, total asset, nope, let's go to accounts receivable turnover. We see that this number has gone down. So that's not a good thing. They're taking longer to receive their accounts receivable. Their payable turnover is lower as well. Inventory turns have went from 207 to 186. So still astonishing level, pretty high number, but they're not doing as well as the previous year. Some of this can be attributed to the fact that some of these new McDonald's locations, especially the ones they own, may be bigger and holding more inventory. There's something, they may have, now that they have all-day breakfast, maybe they have more inventory for that. There's some sort of reason that you'd want to look into that as a manager. Average days of receivables and payables are up, which would also correlate to how the turnovers are lower now. That's going to result in increased number of days to pay. But I think what they're doing is smart. Because the receivables they have less control over, that decrease, they also decrease their payable rate to help make up for the change. If they didn't do that, they'd lose too much in cash flow. So basically, if people delayed paying them by 10 days, they delayed paying their vendors by 10 days, so that way their cash flow didn't change too much. Days of inventory on hand is about improved a little bit, close to about 2 days of inventory on hand. Okay. Some of these, this website gives you everything. We don't need to look at all of this, but let's just go down a little bit. I want to get to the profit margins. Okay, so net profit margin, the most very significant here. Net profit margin went from 23 to 28%, which is a significant increase. And that's really what probably drove up the stock price and the PE multiple, is that the net profit margin has increased. So I don't like how they don't put the operating and gross profit margin near if they calculate it at all. All right. Okay, so that would just be sort of looking at how McDonald's progresses, and let me take 2018. I don't want that first. Put 2018 in there. Okay, so I'm going to delete these two since they're such giant numbers. Delete that. Resize these columns. All right. So this, now if you're a very serious financial analyst, you may look at all, we have about 62 items here to look at, which is a lot of points of data. Take out these. These aren't ratios so much as accounting facts. All right, so it makes it a little bit more. Let's try to make the viewable space bigger so I can make the numbers bigger here. Okay. So if we look at, now let's just look at the 5 companies together at the same year basis, and to get an idea of how these companies stack up together. And again, I'll save this when I finish it so you can download it later if you want to see the changes I made. So if we look at the PE multiple, you have, the average is 41, but you have a low of 8 for Wendy's. Yum and McDonald's are pretty close, but then you have Chipotle Mexican Grill and Shake Shack at 60 and 84 PE multiple. That's very high. So the reason is you want to ask, if you're an analyst, why is Shake Shack and Chipotle Mexican Grill higher? And the reason is that they're growing much faster. These other established brands have pretty much extended their companies everywhere and have a lot of the best locations already been set up. So what they're opening up now are smaller locations, less profitable locations, where Shake Shack and Chipotle still have a lot of great cities and countries and locations to go to open up very profitable restaurants. So investors say, we like Shake Shack and Chipotle better because they have more future opportunity. Wendy's is going nowhere. It's being eclipsed by Popeyes and some of the other restaurants, so we're not going to pay more than 8 times earnings for Wendy's. But we'll pay 84 times earnings for Shake Shack because they still probably have another 5,000 restaurants they can open, or even 2,000 restaurants they can open. So they can easily double, triple, or quadruple the amount of outstanding restaurants. But if you're McDonald's and you have 20,000 restaurants, I'm making up these numbers, it's not going to be easy to go from 20,000 to 40,000. But if you're Shake Shack and you have 500 restaurants, it's a lot easier to go from 500 to 1,000 than it is to go from 20,000 to 40,000. So there's not as much growth available to McDonald's as there is to some of these newer, younger, hotter brands. So investors like these companies better. Okay. So just let's skip down here to, if we look at the quick ratio and current ratio. So what I'm going to do here is I'm going to freeze this top row so we can always see it, so we know what company we're looking at. See, so now I scroll. So here we have current ratio, quick ratio. Wendy's doesn't really seem to be doing that well in these ratios. Let's put them in red, because not because they're negative, but they're the highest. Actually, no, that's good. That's not bad. The higher, the better. So actually, Wendy's is doing pretty well for their current and quick ratios, but that doesn't really always translate into profits. So investors aren't always so crazy. They won't make a decision based on quick and current ratio as long as it's above 1. There's no reason to buy or sell a stock. Total asset turnover, it looks like Chipotle Mexican Grill has the highest total asset turnover. Basically means that their locations are doing more business. So, or maybe it's more less expensive, which it definitely is. If you make a Chipotle Mexican Grill location, it's probably half the cost of making a McDonald's location. If you look at a Chipotle Mexican Grill, there's a lot less restaurant there. And they're not really, there's like, 5 ingredients they make into 6 different products? It's not as complicated as McDonald's, so it's a lot cheaper. So their asset base is smaller, and their return on assets is higher because they generally have more sales per square foot in their stores than McDonald's do, because they're just a busier, more frequented location right now because it's a new thing. And also you see that Yum and Shake Shack are pretty high on the total asset turnover as well. So if we look at return on assets, return on equity, and return on investor capital, we see that return on equity is negative for Yum and McDonald's. And that could be because they have very high amounts of equity. But as far as return on assets, again, we see Yum has their net profits to assets are probably outstanding compared to the other categories. But we're sort of getting a mixed bag here. No one's coming out as the clearest winner. Yum is better at doing its accounts receivable. Actually, the accounts receivable turnover is the highest for Chipotle Mexican Grill, and the lowest, I guess, would be McDonald's here. So these are all sort of semantics, looking at a lot of these different ratios. The bottom line ratio that you would really want to look at is definitely these cash flow ratios. Revenue per share is important. Cash flow per share is very important. And it looks like Chipotle Mexican Grill has the best cash flow per share of stock, followed by McDonald's. And then if we look at the net profit margin, which is, I would say, the most important, because this is the money going into investors' hands, we have actually Wendy's with the highest net profit margin compared to next McDonald's, very close to McDonald's, and then Yum Brands. But Chipotle Mexican Grill and Shake Shack are pretty low in net profits, which is consistent with a business that's growing and expanding and taking on has a lot of expenses to build a lot of new locations. So looking at this financial ratio versus, of course, each of the companies and industry average, we get a clearer big picture of how these businesses are different. So understanding all these different, and I picked this industry because we're familiar with these companies. The more familiar you are with the company, the more you can kind of see how these trends, what the business is trying to do, is changing their ratios. And that's why the annual report has a management section to talk about the financial ratios to help explain how they're different from their competitors, what's been happening, what they're investing in. And overall, you can see how it is difficult for an analyst who has to cover the fast food industry to really understand all these ratios, their financial reports, and the changing management scope of these companies to try to boil down a recommendation to it for investors of what to invest in. Okay. All right. This ends the lecture portion of the class. Now we're going to move into some more class-specific information about simulation, due dates, tests, all that jazz in a second. Take your question in 1 second. What I'm going to do with this little changes I made